welcome to this webinar. I guess we have been talking about small caps for some time now, probably from the start of this financial year when we came out with a contrarian report. At that time, small caps were very negative, and they were at a significant discount, which is also why we chose to come out with that recommendation. And since then, we have started out trying to run our investors through, the mid and small caps. And since we've seen a reasonably good rally, I think this is a question on everybody's mind, right? So that is the mid and small cap rally sustainable? Yeah, the first one is about, the returns for the year, which is why a lot of people have been asking us, do you think it's still a good time to invest in small caps, right? Do we think that sort of time period is over for small caps, etc.? And the reason is from April to date, okay, in a short period of time, the small cap index has delivered 25%, right? The Nifty mid cap has also been reasonably strong, and it's delivered something like 22.4%. And Nifty in this period has been, actually the return is good if I look at it on an annualized basis, but it's pretty pale in comparison to how the mid and small caps have done. This is sort of in line with our expectation that, mid and small caps in our annual report at the beginning of this year, we actually came back and said, we think mid and small caps sort of will do well in this year. So based on this, I just wanted to run a poll. Normally I do a poll, and with small caps running up 25% plus, do you think it is overvalued now? Yeah, thank you. So actually, we'll end the poll, and it's interesting. Okay, 55% of the people actually feel that small caps are overvalued, and 45% feel that it is not. Okay. In fact, for some time when I was looking at the poll, it was a very even battle. It was 50-50% for some time, and then I think it's in favor of people being negative on small caps. Okay, thank you. You're able to share the results. Yeah. Yeah, thank you all for polling. So yeah, so as usual, I'll have my slides a little heavy on charts. Okay, so and a lot of it I will try to look at in terms of data and chart. Okay, so this is looking at it a little differently. If we took, July 2018 to date, okay, which is about 5 years. If we looked at it, and we saw how large caps, mid caps, and small caps have done. The one in red is actually the small caps. Interestingly, the small caps have done far lesser than large caps. Okay, if we looked at a 5-year period. Okay? And just putting that in a little bit of numbers and color there. Okay, just to give you an idea. Since 2017, Nifty small cap is up only 2.6% per annum. Okay, so I think FD would have done better than small caps in this period of time. Okay, so on the other hand, Nifty 50 has been up a healthy 12, almost 11.5% per annum, and mid caps have been stable at say 12.9%. So and this was one of the reasons why we felt it is likely to be a larger move. And typically market cycles correct, and when you see in the longer term, you'll probably find a bit of a spurt, from whoever is the underperformer, Okay, and there is a bit of a catch up because typically, small cap is higher risk, higher return. Okay, but there are periods when it underperforms, and those are periods when we like to sort of come in where we feel there's a turning point likely to happen. And that's broadly what happened when we, looked at it something in end of March. You can imagine how it was at that point of time, right? Even the past returns were pretty poor at that time. Right now, after the 25% sort of up move in small caps, the Nifty small cap index is up 2.6% per annum only since 2017. The other point that, and this is something that one likes to share with people, that, how have small caps done in the past? Now, you may come back and say, yes, the previous slide, it's only done 2.6%, but does it mean that small caps don't do well at all? Okay, this chart actually shows that small caps, when they rally very fast. Okay, and they also go up very well. Okay, so if you see a typical average gain from the bottom in a small cap rally is 220%. Okay, which means if you had invested, say, 1 rupee, it would go up to, say, 3.2 rupees, right? So that is the 3x, which basically means a 20% type of return. So that is how small caps, have done. Okay, so if you see here, and we go back and look at each of those cycles slightly more in detail, in Jan 22, we saw, a rally of 3.5x in 22 months. And so from Jan 22 to now, we've been in a very, very sideways type of move. So almost like, 1.5. So a good period of time, you've seen that, the index has been static there. So similarly, if you went back to 2018, Jan, 52%, 3.9x in 52 months, right? So that was a slightly longer period, but again, a healthy return out there. And even if you see the chart, I think a lot of it has come back, if I look at a shorter period of time, that also has been sort of reasonably steep out there. And 2010 November, 3.9x in 20 months. Again, Jan 08 is 3.1x in 19 months. Okay, so and if you go back, it's a similar one. In 6 months, it gave 1.6x. Okay, so that's something that we keep in mind. And actually, if I look at ideally the small cap rally in that between Jan 03 or December 03 and Jan 08, it was a great 5-year rally, and we've just broken it up based on the corrections that the index saw. So that is something that we sort of keep in mind, that when it moves fast. The other one also I wanted to highlight out here, that when the fall happens, it also falls reasonably. So the average decline from the peak is 45%. Okay, so that basically means that when the falls also happen, they also can be steep, which is why, we took a certain call when we came out with a fund, right? Super value aggressive. We said we'll keep it open for a limited period so that, people come in early enough, okay, and, they don't participate in, after the market has really gone up and, falls down from there. So that is something that we look at, and keeping in mind that the upcycle range is, say, 24 to 32 months on average. Okay, we believe that there's at least data tells us that we're probably at a good place, and the rally should last longer, both from a percentage gain and from a time period. So there's a lot more left out there. Let's look at also valuations, because the whole question is, are they overvalued? Is it likely to fall? And stuff like that. So if I look at valuations, and we said here we look at the multiple large cap, mid cap, and small cap. So you get a perspective of what is where. Okay, the Nifty, for example, a 5-year rolling return, which is basically we came upon looking at 5 years, okay, periods of time, and so it's at a average valuation. If you see the blue line, okay, we are closer to the blue line. So large caps are, in line with the long-term trends. Okay, Mid caps are slightly above. We saw that mid caps have grown faster as well when you looked at 5-year returns, faster than the large cap index as well. Okay, so that is why it is a little above, and the small cap variations are still cheaper even after this reasonable, good, and strong rally. It is cheaper than its long-term averages. Okay. Now we also look at it from an earnings growth, because in the long term, what we see is stock performance is in line with earnings, right? So earnings is, I'm just saying, profit growth, right, is what I mean. So if the profits of a company, I'm just saying, for example, grows up 15%, typically you will find in the long term, say over 10-year period and stuff, right, you'll find typically in that period the stock price growth also will sort of converge there. Okay, is what our experience has been. So this helps us to understand, do we think there's a overvaluation or undervaluation, from that standpoint. And it's interesting that the last 5 years earnings growth has been very strong, okay, despite COVID and the impacts out there. So 16% has been the large cap, mid cap is 35% almost, and small cap is also 35. But you will find that the undervaluation from small cap sort of is the highest, thanks to the fact that earnings has grown, and they've actually, the stock price has grown the slowest, or grown slower than the earnings growth. So that's a point as well. Small and mid caps are an important one, and specifically when you're looking at small caps. Okay, so if you look at, why should you look at small caps and not miss them out, in a period like this is, so if you looked at, you've just taken the India, Nifty 500, right? And if you look at that index, we've looked for stocks that delivered 10x in a 5-year rolling period since 2000. Okay, so what is interesting is almost like 54% for India have been multi-baggers, right? So and strong multi-baggers. So that is something which has been much higher for India versus other markets. So an equivalent, say, in the US is something like 16%, right? So that is what you keep in mind. And you look at the performance of the indices in this period, right? 10 to 20. India was lesser than, say, the Nasdaq. 20 to 23. So this decade, India sort of picked up. Okay, so and if we continue to look at, I mean, the question mark there. Okay, where do we think it will be? We believe that India will, be much higher, and one of the key rationale for that is looking at earnings, right? Because if earnings have been so strong, the stock markets have not yet caught up with the earnings growth. Okay, is where we believe that that will sort of drive stock performances in this decade for India. In fact, we have been for some time saying that we believe that India will be the leader of this decade in terms of market performance. Again, small and mid caps are not to be ignored, because they're very diversified. So if I see like in the large cap index, you may see concentration to all financials, that is including banks and other financial institutions. Out there is something like NBFCs, everything. So the large cap index has a 41% concentration there, but the small cap is really sort of 12.5. So the small cap index is much more diversified for somebody who's willing to work a little harder, study deeper, and track some of these companies. Okay, there's a lot of space for you to invest into and have sufficient diversification out there. Okay, and we think that the sweet spot in our view is the 500 to 20,000 crore market cap. Okay, so that is something which we believe is a good thing to sort of look at out there. And this is a chart table which shows that today's mid caps are tomorrow's large caps, and what happens when they become large caps, right? We We already looked at how, what is the percentage of companies which are growing very strongly, in the, say, Nifty 5, BSE 500. So you're finding a lot of them actually are growing up, and when they move from one band to the other, right? For example, is where you will see how the differences happen when it moves, say, to large. There's a good sort of move when you find from, say, mid to large, and those sort of performances are much stronger as they sort of move the band. Okay, so that is something which we keep in mind, that as some of the small caps move into mid caps and they move into large caps, they deliver very good stock performance during that periods of time. Okay, and coming back to what is it that we need to keep in mind, okay, because is all looking great, returns are going to be always fabulous in small caps. We saw from the past, not necessarily so. And what is very stark out there is, how companies perform within small caps. Okay, there's a very wide range, and this is something that we need to be careful about, and that's why we need to dig deeper and ensure that you are in the right stocks out there. So the right table that you have, which says basic small cap, 10-year returns are reasonably strong. The 5-year returns have not been great. Okay, but so if you see, the long-term small caps have done reasonably well. Okay, but the top quartile average is 37.2% 10-year compounded return. It's mind-boggling, right, in terms of the return. But you also keep in mind is the bottom quartile, right, has delivered nothing. Okay, when the index has, which is 2.2%, when the small cap index has delivered 16% per annum. Okay, which is broadly coming back to a point that you have to be careful about what you sort of invest into, and if you get the companies right, okay, and you're in the top quartile, fabulous return. But if you don't get it right, and you're not able to identify the leading top quartile companies, okay, and you get off into the bottom quartile, you may not earn anything that period of time. So and the whole point is also that the probability of positive returns, again, just looking at data in this, let's say, last 19 years, we just did a bit of a thing, research out there. Returns were positive 68% of the time. Okay, so that is the interesting statistic. Okay, which means that out of 19 years, 68% of the years we would actually have seen a positive return. Okay, we are talking about the percentage of times return, which is number of years, right? So that's how we're looking at it. So we started off with minus 50%, which means companies which have grown, fallen by 50%, in that year, or the index has fallen by 50% a year. Okay, there are 5% of the times it is there, but greater than 50%, we have almost like 30%, 32% of the time, almost like 1/3 of this period of 19 years, right? So almost like 6 odd years, you would find that the returns are greater than 50%, right? And if you look at it, that is in one financial year or one calendar year we've taken out here, the returns are above 15%, and similarly 25 to 50%, which is a decent thing. So it has been something like 16% of the time. Now, what we are saying here is 68% of the years will find that it has given a positive return. Okay, so this tells us two things. One is, yes, if you were in small caps, you'll probably see positive returns. However, there are almost like 32% of the time, okay, there may be years where they don't do well. Okay, so which is where when we look at small caps, we also look at the time at which it is you are investing, and that is the important point. So if you are doing in an SIP, we don't mind, say, having a certain allocation to small caps, but yes, we do switch it and increase it when we feel the past period, the returns, have not necessarily been as good as, say, the earnings growth, etc. So that time we go and switch money from, say, large caps to mid and small caps, which is broadly sort of what we've done. And there are also these times we come out with, like we have on the PMS, we have a scheme that we came out with in terms of super value aggressive. And we also encourage investors then at that point of time to put money more. So what I'm trying to say is, one is you have to be careful about the type of stocks that you invest into. The second is, one is saying is, when you look at small caps, you have to be careful about the period at which you invest into. Okay, so if you invest in periods when the small caps are overvalued, it's not necessarily going to be good in terms of return. Okay, see the other aspect that, and what is the whole logic of why should we still be looking at it, right? So you will find the whole consumption story of India, which is likely to evolve in a reasonably great way. Okay, you're finding that the income distribution is moving up the band, right? So when that happens, you will see that consumption really improves. India also has a very low demographic age. Okay, so you will find a combination of those. The spending also, when that is likely to be higher in those periods of time, and it's also aligning with when we just look at it from the household's income and the number of people, number of households that are coming into those brackets. So which is why you will probably find the India growth story going to play out very well over this and possibly the next decade, right? So that is something which we're saying. And small caps, typically, like we've seen, 10-year returns are strong. They deliver the best. Okay, and so when they get off into a growth engine, then there's no stopping. Yes, this is also about India moving and looking at it how in developed economies, as the per capita income grows, how different sectors will start unraveling and growing much faster, and contributing to the GDP out there. So those are something that is likely to change. So while we invest into sectors, stocks, etc., yes, we also look at which sector, subsectors of within consumer, retail, grocery, non-grocery, etc., non-retail consumption. So all of those are areas that if you're able to look at that particular segment, sub-segment, and you're also able to see which companies within that sub-segment are likely to do well, it will also help you look at the stocks which sort of unravel better. Okay, so one of the things that we have tried to do, and how do we look at small caps? We look at a combination of growth and value. Okay, so growth, by growth we are saying growth in earnings, because or growth in profits, right? And so if growth in profits for companies are strong, you'll probably see it reflecting in terms of stock price. And if also the valuations are lower and the valuations expand, that's what a combination of growth and value stuff will help us get the multi-bagger type of returns. And that's a framework that we have looked at it. And yes, there are risks around business risks in small caps, for example. I joke many times that you have to be sure that the factory that is there, right? Because while things are in the large caps, there's a lot of research reports, there's a lot of people visit factories, all of that, and the likelihood of corporate governance issues being negative are much lower. But in small caps, there are a lot of corporate governance issues that one needs to be careful about. So that is something which we do go and look at it. The second is also if for smaller companies, if one is not able to hold your own against some of the larger brands, larger names, etc., then you can just fall off the cliff. And so that is something that one needs to look at. And so that is one aspect to dig deeper, look for some of these companies, research them more, and sort of look at it. Yes, we also look at valuation risks when valuations run ahead of their earnings. Then that those points of time we look to sort of pull back and even exit the stocks. It's something that we have done a number of times, that where valuations are high, we take money out of the stock. Corporate governance risk is something else. I already discussed about this, so I'll not spend too much of time on this. And what is interesting, and this in a period when, of course, this is up to the end of sort of last month. Okay, so since the end of last month, this is where we were, 35.8% from April to July, right? So just a short period of time, we've seen that strong, almost like 36% return, while as per SEBI, we need to compare it with the BSE 500 TRI. They have specified, for each fund or the 3 indices that we need to benchmark against. Okay, but if you looked at even the small cap index, we saw it somewhere closer to 25%. So even if we compare it versus a small cap index, it would have done far better there. So that has been a good thing, and I think my team, that Vijay and Prabhat, get the credit for significantly running super value and super value aggressive. In summary, because I wanted to spend time, this time, more on questions. Okay, so I said, okay, let me have content a little shorter this time. Okay, so just to summarize, we've seen a very, very good and steep rally in small caps, right? So there has been, a lot of people come back and say, yes, it's already run up. Should we exit to start off with, or should we continue to invest in some of them? Okay, so that is something which we came out with the contrarian call, so we were not surprised by the move. When small caps move, they move up very, very sharply, and many times they don't give you an opportunity to come in. Okay, in between, sometimes we wait for a correction, and then we will enter. They typically don't give you too much of an opportunity. Yes, there will be some corrections, but they are very small. And before you know it, in a quick period of time, when small caps rally, they run up fast, right? So that is something that we expected, and like I said, we also launched a fund out there just to take advantage of it, and so that's something which we are actually about to close right now. Okay, the past data on small cap cycles, tells us that the index typically moves up 3x. Okay, so if you had 100 rupees, it actually moved up about 300 rupees on an average in a single cycle move of small caps, right? So that is something which is very good and attractive return. So if you look at from that perspective, since small caps have moved up 25%, one still believes it's not even 1/4 of the normal small cap rally, right? So that is one aspect to sort of keep in mind. So we think that there is more room left. 75% or 80% of the rally, we believe, is still to come in small caps. And the second aspect is about, we think that from a time perspective, we also believe that the typical cycle rally is 24 months. Okay, so that is something that we sort of keep in mind. Yes, there are times when it has gone longer. Okay, and there are times we've seen a very, very quick 1.6x in some 6 months. There was one period that we looked at it as part of maybe a larger small cap rally cycle, but this is sort of a average that we think. So from both time period basis and from a percentage return basis, we think there is more to come on the small cap side. Okay. On the cycle completion, we need to, and this is what I also laid it out, that we have to be cautious about a couple of things. One is when the cycle completes, the corrections in small caps are steep. Okay, so it's important to set aside, long-term money. Okay, so when you look at your sort of investing corpus, right? So, and you say, I want to put 100 rupees, into the market, I need to put that much of this 100 rupees, which I know I can at least keep for 5-6 years. Okay, and why is that important? That's important because just in case, we are wrong, in case, the market falls instead of going up, right? And if it is a trap that sometimes market sort of creates out there. So if that is the case, then you need to wait it out for a period of time. And, possibly then the next rally is what, if one wants to exit, one can exit. Okay, so that is a point to keep in mind, that, the corrections also are steep, which is why we are, looking to not, keep this particular super value aggressive open for a long period of time, because unfortunately the tendency for investors is to see, okay, I saw 100% return in the past and now I'll enter, right? And that may not be the best time to look at it. So we wanted to cap it early in the thing. Yes, the other thing that we are keeping in mind for the fund, super value aggressive, is that if we are uncomfortable with valuations on small caps, then we may even, we are keeping it in mind that we could, close the fund and return the money back. So we've kept this fund, with a perspective that let's also take advantage of the market cycle. And because what we feel is sometimes investors don't, may act upon advice of, say, taking money out. We think at a fund level itself, we may take out money if we think that the cycle is getting negative, or likely to get negative, and maybe valuations are stretched. Okay, so that's something that we're keeping in mind. And there is something that even if you are investing in small caps, if you don't want too much of volatility, that is, it's good to book profits, but you first need to be clear, in terms of market valuations, that yes, we think the rally has ended, because you don't want to miss out on a good part of this 3x, which typically this, thing ends up giving, right? So that's something which, so just to, there's no point in taking out smaller returns, right, and missing out a larger part of the rally. The variance in returns in small caps are high, which is a point to be kept in mind. That so if you are investing in small caps yourself, it's really important to research companies deeper, look at, corporate governance issues potentially, and not just use stock tips. There's something that, in such times, and once, momentum catches up, one believes that we'll see a lot of things flying around the place. And, there are companies with corporate governance issues which may come up and do very well in these periods of time. Okay, so one needs to be, cautious about that. From our side, from our PMS, we are very, very, we like to look at both cycles. We also like to look at, companies, study them deep. We have a full-fledged process. In fact, the whole investment journey that, which I've taken previous webinars on how do we have our investment journey. It's sort of broken up into 4 sub-processes, right from screening to, tracking of the companies which come under the screen. Okay, in there we also rank companies. We then do, we have another process for risk, okay, which we call risk radar. And in there we look at, corporate governance issues. We look at, any other parameters. We look at exposures and stuff like that. And the last is we look at, valuations, and what points to enter and exit. So that is something which, so if you are doing on your own, so that's something that is important to keep those in mind while you are sort of working with small caps. Okay, Right Horizons has a methodology, where we have tried to look at, how do we identify multi-baggers, and we look for companies. In fact, in the last webinar, I did cover that a little bit. We look for companies which can, grow their PE, the price by earnings ratio. So the basically companies with lower valuations sort of then they see the benefit of growth in PE. The second thing that we try to identify is companies which can at least grow their earnings 2 to 2.5x in 5 years. So because if that happens, then you normally see that stock price also moves up and doubles out there. So that is something which is there. Yes, lower valuation can give a kicker and more than double, which is where the whole multi-buyer framework and concept is. Okay, and we also shared examples that we have done in the past. So that is the whole journey. Okay, so where if you want to invest in small caps, I think you need to go deeper. And with this, I end the webinar. And just to summarize, yes, things have been very steep in terms of returns, but past data shows that it's only maybe 20 or 25% off the overall move. Yes, but look at a longer term perspective. If you are sort of looking at small cap, just in case one is wrong about it, and instead of going up, say for global factors, you may just find that things sort of deteriorate. Even there, one keeps in mind that a lot of the time, the news that you see, right, when it's very negative, I always say that's a time that again you see up cycles, right? It was, and those are not only India but even globally also. When the news flow is the opposite, I'm always much more comfortable, in taking the view. So I'm happy to take questions from here.
Thank you so much, sir, for sharing your valuable insights. I will be reading out the questions. I would like to request all the participants to post your questions and queries in the Q&A sections. We will be taking it one by one. So, sir, the first question is, I have a HDFC Bank at 106.26 and current price is 105.60 and looks very big. I have been holding since long time. Do you advise me to book loss and move to small cap and mid cap, or average a downfall in coming days? Is there any issue with HDFC Bank that is not growing price?
See, there are periods when there are moves between large caps and mid caps. In fact, one of the things that we also look at is we look at relative valuations between large caps and mid caps, right? So from that perspective, also we find that this is a period where mid and small caps are likely to do well. Okay, so large cap stocks, and I don't want to comment on any particular stock on thing because for compliance reasons as well. Okay, and yes, we do hold disclosure. We hold HDFC Bank in some portfolios of ours. Okay, but they may be slightly portfolios which are more focused on large caps, or maybe a flexi cap where we want to keep a certain exposure to large banks and financial institutions. Yes, there we may at certain points of time say, okay, HDFC versus ICICI or Kotak and all of those, and up and lower the weights at points of time. Yes, in the past we have lowered weights for HDFC Bank than what it was in a period where it did very well for us. Okay, so the point I'm making is it's a large cap, and in a period where large caps sort of underperform, mid caps, yes, it is likely to happen. But I think it's important for you to look at your portfolio, right? It's not a right thing to say, should I, because mid caps are doing well, all of my portfolios stocks I can move into mid and small caps. I cannot, right? So you need to see how you want to balance your risk and return. Right? So for part of it, it will still be good to hold large cap stocks. Okay, so the question is, will HDFC continue to sort of do well? I think at least the current data shows that companies continue to do the right things, right? Only thing, the size has become larger, so the percentage growth in earnings, etc., and maybe even stock price may not be as much as say a mid and small cap. Okay, so so that is something. But stocks like HDFC Bank, and I'm not saying only it's HDFC Bank itself, but I'm saying there are a lot of blue chip stocks in large caps which will give you safety to your portfolio, right? And that is something, it may make sense for you to keep to the extent of your risk appetite, right? So, so look at both of those factors. If you have higher large caps, then yes, you can go and increase your allocation to mid and small caps. As part of that, you can take it out. But if, and not only that, you have to look at others, HDFC versus others, which in my view will, give the most stable returns, right? And consistent and also grow. So those are the stocks you sort of keep, and you may take out something which you think may not grow going forward. Yeah. So in summary, not appropriate for me to give you a call on, sell HDFC Bank or, or hold. Okay. You need to look at your portfolio, and as part of that, decide on what to do.
Thank you, sir. The next question is, how you choose small cap companies, any criteria or framework you follow?
Yeah. So, see, today, we use a lot of stuff, including we have a screener. Okay, so that is something which is the first step. So we look at operating parameters, because see, what a lot of the time we want companies which have strong operating parameters, and then we believe valuations are also cheaper, right? So we have a full screening process for that. So what we do is, in the whole universe of stocks, first of all, we may exclude some, based on various criteria. Okay, so we may exclude some based on if they're really small, right? And there's no liquidity out there, so it may not make sense to even look at them, however good the company is, right? So, and because what those do is, tomorrow when you want to sell, you're not able to sell, and you may just see a huge loss because, liquidity is not there, right? So we may have certain criteria which we exclude. Then we look at, universe of 1,300 stocks, and from there, we apply certain screens. Okay, the screens could be including looking at, say, long-term revenue growth, long-term profit growth, other factors like return on capital employed, and various others. So, and then we sort of, come back to a smaller list. And from there, we go a little deeper. Then we go a little bit more bottoms up as well, because, it's possible that at a certain point of time, a particular sector is doing very well, and all the stocks may come up there, right, in your screen. So you want to keep diversification, you want to look at other stuff, you want to go deeper, which we, from a strategic side, are likely to do well as we go forward. So there are a whole lot of, things that we do before. In small caps, we also try to have calls with management. We also, as far as possible, also go and visit their factories, or even if it's a consumer good thing, we may even visit, so a mall and stuff like that, and see how things are going, etc. So those are, things that we do. For a small cap, also we look at corporate governance issues a little bit more. Okay, before we, look at it in terms of investing, we do a background check on promoters for any legal issues. Okay, so there's quite a lot that happens, and this is, one has a team of, for example, 2 co-fund managers who support, who I would say eat, sleep, drink stocks. Okay, they're very passionate about it. One is Vijay is an IIT IIM, and Prabhat, is a CFA. So very strong on doing research, and they are also supported by an analyst team. Apart from them, one also has 3 other fund managers. So I'm just saying, there is a lot of effort. There are a lot of technology tools and screeners and stuff that we use. The good part is, for an individual investor today, you have these online screeners which are available, which you can sort of look at, and possibly that may be one of the things to look at and start off with.
Thank you, sir. The next question is, how do we minimize the risk in the portfolio, or we are okay to add excessive risk in the portfolio while chasing the large return in small cap?
Yeah, so see, there are risk is about managing risk is about discipline. First of all, you manage risk at each stock level. Okay, you look at companies, corporate governance, and all that, right? I said we have the whole risk radar framework where, as part of our investing process, before we onboard a stock, we look at forensic and other parameters, and after onboarding a stock, we track certain parameters on an ongoing basis. Depending on when data is available, it could be weekly, it could be monthly, it could be quarterly, based on when data is available. Because quarterly results, for example, may come out once in a quarter, but you may have certain parameters based on, say, the trading and stuff like that that happens, right? If there may be disclosures to the stock exchanges, at any point of time. So those are things that we may need to track on based on some event trigger or some information or some news trigger, right? So one needs to sort of go through the whole thing out there and process, and I think it's about, managing risk is one at a stock level. Then you start looking at managing risk at a portfolio level, right? So it could be, let's say, at a sector, etc. The third you would do at at an investor level, where you say, okay, first of all, what is my debt equity? Okay, in line with the risk appetite of mine, debt equity goal, basically asset allocation. Within that, within equity again, and that's where I'm coming back to, small caps should be a percentage that you are comfortable with, right? And like one said, small caps is definitely money that you should keep away for a long period of time. If you're doing it yourself, you should be deep in terms of your researching. Okay, but if you're giving it to somebody else, and a fund manager, then you have to be comfortable with the fund manager and the track record. Okay, there have been cases where there have been funds which have delivered very strong returns. When markets were doing well, and when the correction happened, they also fell very sharply. So yes, you have to manage risk at various stages, and in the end, that's the whole thing, right? So higher risk, higher return. So what is the right risk for me? Okay, that should determine your return, your risk. Sorry.
Thank you, sir. The next question is, let's say if I'm already an existing client of RH PMS, does it make sense to move to invest in the RH super value aggressive?
Sanjay, I'm not able to hear you. Can you repeat the question?
So the question is, like, if I'm an existing client of right or RH PMS, does it make sense to move the fund or investment to the RH super value aggressive?
Yeah. So see, what I would suggest is, I don't think it's a one size fits all. So please do come back. We will study it for you and say, is this the right thing to do in line with the overall portfolio? Okay, and happy to sort of support. Today, apart from the RM who is sort of client facing, each of them are supported by an analyst, which sort of I personally oversee and spend time with them on sort of the market view cycles, everything. Okay, and we even have a model portfolio from our side that sort of we track and look at. Okay, so that is something that it may make sense for us to look at it for you. Okay, and suggest what is right for you.
Thank you, sir. The next question is, what is the fee structure of RH PMS and churn ratio?
Yeah, so different schemes will have different fee structures. So happy to share with you. See, the Super Value Aggressive, which is a small cap, has reasonably it's performance based, because we wanted to tie ourselves in line with its performance. Okay, We didn't want to happen that when market falls sharply, then we're still charging a fee. Okay, so we've kept that way because it also moves up and down. Okay, so the others, it could depend on right from 2.5% is some of the strategies. You will have, say, some of the multi-asset ones, which will be at different points of time. So I think, again, we're happy to share with you, depending on which scheme that you're looking at.
Thank you, sir. The next question is how the US interest rate movement will affect the equity markets for India.
Yeah, so the first of all, it'll always impact, right? So there's no question about it. Where it is extreme, right? The impact can be higher, and we saw that the last financial year when inflation suddenly went up very high. Then interest rates sort of went up, and it is there. Now the only question is, a lot of the time when the Fed intervenes, when there's a lot of noise, you may not realize what is actually the underlying thing, right? So at the peak of all this inflation going up and Fed being very assertive that it will increase interest rates and stuff like that, we ended up taking a contrarian call. Okay, and it was argued that interest rates are not likely to increase any or not much, at least going to slow down significantly. Okay, and so one of the things we looked at yields, for example, the government bond yields. And what do I mean by yields? It's basically what is the interest rate sort of divided by market price, right? So, and that tells me, and why is that important? That tells me because what is the at the interest rate scenario as, right? And that may be slightly more forward-looking. Okay, so that's something which you can end up getting a lot of the time wrong if you just went by seeing, okay, Fed is saying this, I'm going to increase interest rate. It has been saying this for the last 4, 5 months, right? And it has not done too much. Okay, in the previous time, it just overnight suddenly started increasing, right? But the market yields had already spiked by then. So what's interesting, the market is able to sort of look at it. It looks at inflation and various other factors and say what it is likely to happen, right? So we found right from December to March, the yields were sort of flattish, even though there was a lot of noises that Fed is going to increase interest rates, which is where we took in March, we took that contrarian call. So the point I'm making is, yes, it impacts, but what I'm saying is, from what people say, okay, to what is the actual scenario may be different, because sometimes the Fed is trying to ensure that inflation doesn't go out of hand. Okay, so it may just talk tough. So you should be able to find the difference between somebody talking tough and actually interest rates likely to go up. Okay, so and what is interesting in this whole period, everybody said interest rate moving up, interest rate move up. Okay, inflation in the US has come down and across the board has come down so sharply, right? And from there, ideally interest rates should have come down, right? But because the whole interest rate didn't move up as much in inflation, when the fall happened, also it has not happened. So I'm just saying at this point, yes, it will impact, but am I too concerned about it? I'm not so concerned about it, because I definitely think interest rates will be at a higher level than in the past for countries like the US. It is going to keep on creating an issue. In fact, that's why we are a little negative on the US for for some time. So in fact, we think that this decade and next are going to be periods of pain for the US. Okay, because they had a very low interest rate regime before, which they benefited from, and so when that adjustment has happened, then it's after that it's a longer drawn period of pain is what we think will sort of come in there. So just to summarize, long story short, yes, it will impact. Secondly, whether from here we think interest rates are going to go up sharply, we don't think so, but it will continue to be elevated, and the impacts will be slow and longer for countries like the US.
Thank you, sir. We can take two more questions. We have 3 minutes left. The next question is like, what are the near-term risks that one should be watchful for?
Yeah, so a lot of people are concerned about elections. Okay. So I think global risks are definitely something which are there. Okay. In India, today, I think we are sort of settled down on inflation. We sort of settled down on earnings growth, etc. So I'm not seeing too much of stuff there. Yes, but what could happen is at such points, the types of stocks and types of sectors change. So I may have been used to my fund, which did very well for the last period of time, may not do well for the future. Okay, the sector which was sort of giving me good returns may not continue to give good returns, or the opposite may happen. Something which has been down in the dumps may really rise and very sharply. So that's the thing that even if you don't have larger risks, you have to be looking at a portfolio and seeing what's the right thing to do.
Thank you, sir. The next question is, what should be the CAGR return for next 3 years for small and mid caps?
Yeah, so I call some of this astrology. Okay. Yeah, we do some bit of that. Okay, by looking at data and stuff. And so, in fact, at the beginning of this financial year, we came back and said we think the Nifty should see a 20% return for the year. Okay, so that is the thing, and we said mid and small caps are likely to do better. And so that is, I would believe that this decade is going to be a strong decade for India. At an index level itself, possibly a 15% per annum plus type of return. Okay, and there will be some of the other segments, like let's say if I say a small cap, mid cap, we will do faster than that. But yes, there when you say compounded, I'm still say longer term. There would be corrections in between, and corrections are healthy for the market as well, and we love them. They are opportunities for you to either book profits, if you book profits, to sort of increase your return and stuff like that. Okay, so corrections are healthy, because if it really goes up very, very sharply, then the risk goes up, and when the fall happens, it becomes it falls much faster, and on the downside as well. So that's a caveat for what I'm saying in terms of expectations.
Thank you, sir. I think the last question which we can take, should we do SIP in small cap index or mid cap index or large cap index for retirement?
Yeah. So see, actually, it depends on how far you are away from retirement. If you are, let's say, 15 years, 10 years away, then you can continue to do small caps. If I'm coming closer, if I'm within 3 or 5 years, then actually if I'm within 3 years, I should start reducing my equity itself. Forget about large cap, small cap and stuff, right? So that is something that, we need to keep in mind. So, so small cap, yes, we can also do for, retirement. Keep it to a certain percentage, keep a certain asset allocation. Okay. What we also like to do, is maybe with the assets that you have, let's say you have a mix of large cap, mid cap, small cap, right? We keep the SIP constant, right? But we switch between them. Okay, the funds that are already there, which are long term. Okay, based on the outlook. So that's what I would suggest a little bit better to do. You keep a standard, maybe. So you say, if you have 5 funds or 4 funds that you do SIPs in, you will have a large cap fund. It's okay to have a multi cap or a flexi cap fund. It's okay to have a mid cap and a small cap fund. Yes, at certain points of time, if you have the ability to keep moving them around, small amounts you can look at temporarily increasing your small cap and stuff like that. But more than tweaking that around, I feel SIP is just leave it as is, but you tweak it with the holdings that you already have.